Taxation of life insurance in Canada is a complex topic, but understanding the key concepts is essential for both policyholders and insurance professionals. A personally owned life insurance death benefit is generally not taxable, regardless of the policy's duration, premiums paid, or type, e.g., term, permanent, or universal life. However, other benefits received from the policy before the policyholder's death may have tax implications. Key tax concepts for life insurance. Several key concepts are crucial to understanding the taxation of life insurance policies. Tax-free death benefit. The death benefit paid from a personally held life insurance policy is exempt from tax. This is a major advantage of life insurance for estate planning. Policy dispositions. A disposition occurs when a policyholder gives up ownership rights by selling or surrendering a policy. A deemed disposition can also occur for tax purposes without an actual transfer of ownership or proceeds. Common situations that can trigger a disposition or deemed disposition include surrendering the policy, withdrawing cash, taking a policy loan, or a participating policy paying out dividends. Policy gains. A policy gain may be realized upon the disposition of all or part of a policy. If a gain occurs, 100% of it must be reported as income. The formula for calculating a policy gain is proceeds of disposition, adjusted cost basis, ACB. Adjusted cost basis, ACB. This is the tax cost base of a life insurance policy, and it changes over time. The insurance company will typically provide the ACB when a taxable disposition takes place. Factors affecting a policy's ACB. The ACB of a policy is a key factor in determining how much tax a policyholder will pay upon disposition. The calculation depends on the policy's last acquired date, which is the most recent of these dates, the policy's purchase date, the date ownership was transferred, or the date coverage was last modified or reinstated. For tax purposes, policies are categorized into 3 groups based on their last acquired date. Group 1, G1, policies. Acquired before December 2, 1982, with no subsequent transfers or modifications. Group 2, G2 policies. Acquired after December 1, 1982, but before January 1, 2017. This also includes G1 policies that have lost their status. Group 3, G3 policies. Issued after December 31, 2016, or previously G2 policies that have lost their status. A G1 policy becomes a G2 policy if ownership is transferred or coverage is modified. A G2 policy becomes a G3 policy if it is converted to a different type of policy or if coverage requiring medical underwriting is added after January 1, 2017. How ACB is calculated for each group. G1 policies. The ACB is the cumulative premiums paid to date, minus the cumulative dividends paid out of the policy. This method generally results in a higher ACB, which leads to a smaller policy gain and a lower tax liability upon disposition. G2 and G3 policies. The ACB is based on cumulative premiums paid, minus the net cost of pure insurance, NCPI. NCPI represents the pure mortality costs for a given year. In the early years, the ACB of a policy increases because the premiums are higher than the NCPI. However, as the life insured ages, the NCPI increases, eventually exceeding the premiums and causing the ACB to decrease. The ACB can never be negative. Tax consequences of policy dispositions. 1. Full surrender. When a policyholder cancels a policy, the proceeds of disposition are the cash surrender value, CSV, minus any outstanding policy loans or unpaid premiums. A policy gain will be realized if the proceeds exceed the policy's ACB. 2. Partial surrender or withdrawal. If a policyholder reduces their coverage or withdraws cash from a universal life, UL policy, it's considered a partial surrender. For G2 and G3 policies, a prorated portion of the ACB is used to calculate any policy gain. For G1 policies, a gain only occurs if cumulative withdrawals exceed the policy's entire ACB. 3. Policy loans. Taking a policy loan triggers a deemed disposition. The proceeds of disposition are the loan amount, unless the loan is used to pay a premium, e.g., an automatic premium loan, in which case the proceeds are considered nil. If a policy loan is less than the ACB, no policy gain occurs, but the ACB is reduced by the loan amount. If the loan exceeds the ACB, a policy gain equal to the excess is realized, and the ACB is reduced to 0. Repaying a loan can increase the policy's ACB. Exempt versus non-exempt policies. An exempt policy is a permanent life insurance policy that is used primarily for insurance rather than as an investment. G1 policies are always exempt. G2 and G3 policies must pass an exempt test to be considered exempt. Non-exempt policies are subject to annual accrual taxation, meaning investment income earned within the policy is taxable each year. The exempt test includes 2 main rules. Maximum Tax Actuarial Reserve, MTAR rule. The cash value of a policy's accumulating fund cannot exceed the projected cash value of a hypothetical benchmark policy called an exempt test policy, ETP. Anti-dumping rule. This rule, also known as the 250% rule, prevents large lump sum deposits after a policy's 7th anniversary. The rule is triggered if the cash value of a policy's accumulating fund on its 10th anniversary, and every anniversary thereafter, is 250% or more of its value 3 years prior. If a policy becomes non-exempt, it is considered a deemed disposition for tax purposes, resulting in a policy gain equal to the CSV minus the ACB. Absolute assignments. An absolute assignment is the transfer of ownership, control, and rights of a policy to another person. This can have tax implications. General rule. If a policy is assigned to an arm's-length party, the proceeds are the transfer price, and a policy gain will be the transfer price minus the ACB. Non-arm's-length party. For transfers to a non-arm's-length party, e.g., a relative, the proceeds are deemed to be the amount the policyholder would have received if they had surrendered the policy. This prevents a policyholder from avoiding a policy gain by giving the policy away or selling it at a discount. Special rollover rules apply for transfers to a spouse or child. Spousal rollover. A policy can be transferred to a spouse without triggering a taxable disposition. The proceeds are deemed to be the policy's ACB, and the spouse receives the policy with the same ACB. A policyholder can choose to opt out of the rollover. Child rollover. An insurance policy can be rolled over to a child without tax consequences if the transfer is for no payment, and the life insured is the child or the child's own child. If the child is under 18 at the time of a later disposition, the income attribution rules apply, and the gain is taxable to the original policyholder. This rollover must be a direct transfer and cannot be done through a trust or estate. Tax strategies using life insurance. Using a policy as collateral. A policyholder can use a policy's cash value as collateral for a third-party loan. This is called a collateral assignment. Unlike a policy loan, a collateral assignment is not considered a deemed disposition, so it doesn't trigger a policy gain. The cash value remains in the policy, where it continues to grow on a tax-sheltered basis. Annuitizing the CSV. A policyholder can use the policy's CSV to purchase an annuity to create a steady income stream. This is considered a surrender and will generally result in a policy gain. If the policyholder is permanently disabled, the policy gain can be spread out over the life of the annuity. Charitable giving. A person can use life insurance for charitable purposes in a few ways. Assigning a new policy to a charity does not result in a tax receipt at the time of assignment because there is no CSV. However, premiums paid after the assignment are eligible for a tax credit. Assigning an existing permanent policy to a charity results in a tax receipt for the policy's CSV, and any policy gain is taxable to the donor. Naming a charity as the beneficiary does not result in an immediate tax receipt for the donor or a tax receipt for premiums paid. Instead, the charity issues a tax receipt for the death benefit paid out upon the death of the life insured. Tax implications upon death. If a policyholder dies and is not the person insured by the policy, it is considered a deemed disposition immediately before their death. This results in a policy gain on the policyholder's final tax return, equal to the policy's CSV minus its ACB. A policy can be rolled over to a spouse or a child upon death, provided the spousal or child rollover rules apply. Designating a successor policyholder can help a policy bypass the estate and avoid probate fees, but it does not prevent the deemed disposition rules from applying unless a rollover is in effect.